So today, the Federal Reserve summed up the current state of the U.S. economy using a word, just one word, strong. Shifting from calling the economy solid to strong is more than just a frivolous decision on superlatives. The Federal Reserve is sending a clear message that there will be more rate hikes this year because hikes are warranted. This, though, also underscored by the removal of, quote, for now when discussing those further gradual rate increases. The economy, let's face it, it's absolutely on fire. The question, is it too hot? Let's ask our panel. Nomi Prins, author of Collusion, How Central Bankers Rigged the World, and Jeffrey Cleveland, chief economist at Peyton & Regal. Nomi, let me start with you. The Federal Reserve today, was there anything that surprised you with respect to the language and also the way the market reacted to the Fed?
Well, what I thought was interesting was how intelligent Powell was in his language, which was he had to underscore the strength of the latest GDP numbers, up 4.1%. He had no choice, and he did that by moving solid to strong. The market didn't react necessarily as happily as those words might have indicated. But also, Powell can't talk about some of what's going on behind these strong GDP numbers, which is the rise in debt and other things. So he kept away from tailwinds, and he promoted what's obvious, which are the headline numbers.
Jeffrey, we had the ADP report in this morning. It came in significantly above estimates. This on top of a GDP report that had showed an extraordinarily strong consumer. Even consumer spending numbers were revised higher. So the two-thirds of the economy, the consumer, is on fire right now. And I'm worried about Friday if the hourly wages come in too high. Let's just say a 3 handle, 30% year over year, what the Fed may do, because I think it would be unfortunate if they decided to hike rates right now because of that.
Charles,
specifically.
The economy is in great shape. I think the economy can withstand higher rates. When you look at the low level still on the federal funds rate, I don't think it's restricting economic activity. We grew at 4.1% in Q2. As you point out this morning, ADP number, that's for July. It showed continued strong growth during the month of July. We think for the full year, Charles, we're going to see 3% GDP growth. And that will be the fastest growth rate for the U.S. economy of this cycle. So things are in great shape. We can tolerate a couple more rate hikes this year.
No, I mean, but you're skeptical, right, that the Fed is sort of masking or allowing or helping to aid what's really more of a potential time bomb here?
Well, I think that it's telling. Obviously, no one expected a rate hike to be announced today.
Sure.
Obviously, there's a lot of anticipation for September. I'm not very clear on December. I don't actually think there'll be 2 others as have been forecast, because a lot of what's happening in the growth figure and even those consumer figures has to do with the fact that right now aggregate household debt is at a higher point than it was going into the financial crisis. That's there in the background. So consumers are buying, but they're also buying on debt. And the second thing is, and Powell didn't mention it this time, which is another reason why I think it was a very smart way of producing this statement, is what might happen if these trade wars actually get going. What might happen in terms of consumer prices rising even more so, and more debt being required to pay for things, or just backing off from companies, say increasing jobs or increasing wages. So I think there's a lot of uncertainty coming later, and I think what Powell did was just say this is what's happening now, and what will happen later will be addressed as those results actually start to come in.
Jeffrey, we know that household debt is higher than it was at the peak before the Great Recession, but I think that the income as a disposable income as a percentage, once you paid off debt, also seems to have rebounded to a degree, and some of the composition of this debt has changed a lot. With student loans and auto loans as opposed to mortgage loans. Does that matter to you?
It matters, Charles. I think the households look better now than any time in the past 15 or 20 years. I look at household debt to GDP. That's lower now than it was pre-crisis. You can look at household debt to disposable income. That looks better. You can look at household net worth. Charles, that looks great. So the other thing in the GDP report from last week, savings, personal savings was revised up. So the consumer, I think, is in much better position than people are giving it credit for. As you point out, that's 2/3 of the economy. Yeah. So that's really what's powering underlying growth. I expect that to continue. And if we get, as you said, 3% wage growth on Friday, to me, that's a great sign for the consumer. That's more money in my pocket, and that will continue to fuel the economy. I don't worry about the Fed disrupting this.
All right, well, we got to leave it there. I do believe the American consumer and smarter than he and she were before the Great Recession. But we'll see if they let things get out of hand. Appreciate seeing both of you. Thanks a lot.